$3.5 billion. Let that sink in for a second. That is the massive all-time record-breaking revenue figure Norfolk Southern just generated in a single quarter. To put that into perspective, we're talking about roughly $38 million flowing through their network every single day. Just think about the sheer volume of goods, materials, and industrial products it actually takes to hit a number like that. Well, today, we are going to unpack exactly how they pulled it off. And, this wasn't just some lucky break in a booming economy. As CEO Mark George put it, Norfolk Southern delivered a strong second quarter. He emphasized that the team really adapted to a dynamic operating environment with a laser focus and, this is key, an unwavering commitment to safety. This was an intentional win. And honestly, that sets the perfect stage for what we're looking at today. So welcome to The Explainer. I am thrilled you're joining us. Today, we are decoding Norfolk Southern's record second quarter of 2026, finding the efficiency engine driving it all. We're going to break down this complex financial report, cut right through the corporate jargon, and look directly at the data to see how major operational shifts are driving some seriously massive financial results. All right, let's just dive right into it. Here is our quick roadmap for today. Number 1, record-breaking second quarter. Number 2, safety and operations update. 3, market demand and volume. 4, the financial scorecard. And finally, 5, the road ahead. Let's get started. Kicking things off with Section 1, record-breaking second quarter, the $3.5 billion climax. Let's look at how that $3.5 billion figure actually breaks down. Total revenue hit $3,465 million. That is up 11% year over year. But the specific drivers are the real story here. Merchandise is up 8%, coal is up 7%, and get this, intermodal saw a massive 22% spike in demand, bringing in $908 million all on its own. So this wasn't just an isolated success, it was explosive growth across the entire board. Moving on to Section 2, Safety and Operations Update, Building the Foundation. So how exactly do you move all that extra volume effectively? Well, you have to fix your ground-level operations first. Before we get into the numbers, let's quickly define a crucial metric you see all the time in the rail industry, the FRA Personal Injury Index. This simply calculates the number of reportable injuries or illnesses per year for every 200,000 hours worked. Think of it as the ultimate yardstick for measuring a railroad's cultural commitment to protecting its workers. And the real-world progress Norfolk Southern is making here is actually pretty striking. Comparing the first half of 2025 to 2026, their FRA Personal Injury Index improved significantly, dropping from 1.08 down to 0.94. At the exact same time, their FRA mainline accident rate dropped from 0.56 to 0.49. The crucial takeaway here, leading from the front on safety culture isn't just good for team morale, it's paying tangible dividends in creating a highly stable, reliable network. Now for the operations side of things. Let's define another quick term. Terminal dwell. This is the average time a rail car just sits at a specified terminal location, measured in hours. If you ever want to know a railroad's actual operational velocity, you watch their dwell time. Basically, the longer cars sit, the slower the whole network gets. So, let's look at the data and see how this builds a picture of incredible momentum. In Q2 2026, train speeds increased to 21.8 miles per hour, and simultaneously, terminal dwell dropped all the way down to 21.8 hours. Faster trains and way less waiting around in terminals mean the physical network has some serious velocity right now. They are quite literally doing more with the assets they already have. Management actually attributes this newfound velocity to a strict focus on simple, uncompromising principles. Originate trains on time, reduce that dwell, and just run the plan. They've essentially been clean sheeting their local operations. That frees up crew availability and really optimizes their locomotive power. It's a classic back-to-basics execution, just applied at a massive scale. Which brings us to Section 3, Market Demand and Volume, Moving the Economy. Okay, so we know the trains are moving faster and safer, but what exactly are they moving? The overall 4% volume growth we saw was driven by some very clear macroeconomic forces. On the merchandise side, it's being fueled by vehicle production, industrial activity, and global energy prices. And on the intermodal side, remember that massive 22% revenue spike we talked about? Well, that's being driven by the truck market and a huge surge in consumer and import demand. The railroad really acts as a massive mirror, reflecting the broader economy. And what's incredibly promising for future volume is the acceleration in industrial customer investments during the first half of 2026. We are seeing broad-based capital spending expanding across major sectors like chemicals, construction, food and beverage, and automotive. As these customers build out and expand their facilities, they require more raw materials coming in and more finished goods going out. That directly translates to increased rail volume.
All right, Section 4, the financial scorecard, the bottom line.
Let's translate all of these faster trains and economic drivers into the actual financial accounting. When you look at corporate earnings, you'll often see two numbers, GAAP and adjusted. GAAP is the standard accounting measure, which gave us earnings per share of $3.26. But the adjusted EPS, which strips out one-time, non-operational costs to show the underlying health of the business, was $3.52. That adjusted number, that represents a very solid 7% growth year over year.
So, what exactly was adjusted out to get to that $3.52 figure? The non-GAAP adjustments for this quarter included $51 million in merger-related expenses, $15 million related to the ongoing impacts of the Eastern Ohio incident, and $6 million for restructuring and other charges. By neutrally factoring these specific items out, it allows investors to see the core, day-to-day operational earnings capability of the railroad.
Now, I should mention it wasn't a perfect quarter on absolutely every single front. Adjusted operating expenses were actually up 15%, hitting $2.27 billion. Why? Well, moving 4% more volume definitely costs money, but they also face some steep macroeconomic headwinds from higher fuel prices and just general inflation. In fact, fuel expense and the corresponding fuel surcharge revenues created a 110 basis point headwind to their operating ratio. Finally, Section 5, the road ahead, CapEx, and outlook. Having digested this monster second quarter, how is management positioning the company for the rest of 2026? The strategy moving forward is heavily focused on disciplined execution and strict cost control. They expect total 2026 adjusted operating expenses to land somewhere between $8.8 and $8.9 billion. Keeping in mind they have to absorb a projected $400 to $500 million incremental fuel impact. But the absolutely crucial takeaway here is their capital expenditure. They are deliberately lowering their capital spending to $1.9 billion. That's a $300 million or 14% reduction from 2025, while still fully supporting the reliability of the entire network. They are also being very transparent about the competitive landscape right now. The recently announced merger in the industry has definitely created an enhanced competitive environment. Management openly acknowledges this will likely have an adverse impact on volumes in the short and medium term. It's a very realistic view of the chessboard they are currently playing on. Which brings us to the final thought of today's explainer. They have clearly built an incredible efficiency engine, driving absolute record revenues and speeding up the network. But looking at the rest of 2026, the real question is this. Can this new operational velocity and deeply ingrained safety culture outpace the very real economic headwinds of fuel costs and the mounting pressures of industry consolidation? It's a fascinating tension, and it's one that will absolutely define the future of our supply chain. Thank you so much for joining me for this explainer. I really hope this helped you decode the numbers, and I'll catch you on the next one.